Good afternoon, welcome to Market Wrap number 171. Stuart Williamson here at the helm. This week, great news for property investors on interest rates. So watch on please. Then top tips from investing guru Phil Spencer, property guru at the Daily Telegraph. Then how to save 20% on your mortgage payments. So exciting stuff. But first, APW networking events in Hong Kong and Singapore. Singapore, we had mortgage brokers, prospective developments, Get Ground, single purpose vehicle creation, Godwin Developments and their 12% bonds, and investing in supported housing sponsored by the government. What we're going to talk about tonight is the UK property market a good buying opportunity?
We're a technology company over anything else, and we specialise in the setting up and managing of property holding companies for the sole purpose of holding residential investment property in the UK.
So Capricorn, we've been around for over 17 years, specialise in helping expats and non-UK residents to get financing on UK property.
So exciting stuff. This week, interest rates fall below 5%. That's the big news. This is as indicated by the 2-year swap rates falling below 5%. It's the best news in months, the mortgage expert's Daryl Doffer has argued. Doffer's comments follow the revelation that 2-year swap rates fell to 4.998% as of the 22nd of September. The swap rate dropped following the Bank of England's announcement that it would hold the current rate at 5.25%. Doffer added that it is now surely a matter of days before lenders react and launch more competitive 2-year fixed rate deals. He also expects that within the coming six weeks, the big 6 lenders will come out with 2 deals beginning with a 4. Great news. Shaw Financial Services owner and mortgage expert Lewis Shaw pointed out that the announcement represents the first time the 2-year swap rate has been below 5% for months. Shaw added that, given the swap rates are one of the main tools for lenders pricing fixed rate mortgages, it's nailed on that a 2-year fixed rate mortgage will start to reduce over the next few weeks. However, he did specify this will only be the case if economic status quo is maintained. And to be fair, Rishi Sunak does seem to be doing that at the moment. Hudson Rose Managing Director Graham Taylor, not the footballer manager, stated 2-year swap rates falling below 5% is undoubtedly a good sign and comes off the back of better than expected inflation figures. With the market subdued, lenders are already starting to price quite aggressively, and we may start to see this competition increase as they are buoyed by the fall in the underlying cost of funding. Additionally, More Mortgages Director Peter Stamford stated, it looks like the swap market is reacting to the base rate decision. This really is a positive signal for homeowners, he said, as it allows banks to reduce rates and ease the pain of movers and remortgages alike. And buyers. It's great news for us offshore. Trinity Finance Advisor Amit Patel stated the news indicates that confidence is now back in the market, and that's what it's all about. If you get confidence back in the market, people start buying, the markets start moving again. In Australia, the US and Canada, that's already happening. Positive news moves the market. However, Rose Capital Partners founder Richard Campo cautions it's great to see money markets falling, but the champagne may still have to stay on ice for a while yet. Campo explained that he expects a slow reduction of fixed rates as each lender buys in new funds at the new lower rate in the coming weeks. He added that this process could take weeks, even months, to play out fully, and was therefore still cautious about recommending any fixed rate mortgage currently, as it's likely to be undercut in the coming weeks. That's great news. Now, next, Phil Spencer reveals his top 3 tips for property investors. Phil Spencer, as you may know, is a trained surveyor. He's best known for fronting some of the UK's favourite property shows, including Location, and Love It or List It with Kirsty Alsop. So he started a column in the Daily Telegraph, and this is borrowed from there. Thank you very much. Phil's top 3 tips. Number 1, Focus on what you can control. When dealing with property, there are many things out of control, so make sure you are putting as much care and attention as possible on the elements you can influence. Don't take your eye off the ball. Focus on what you're really buying for. Buy for the future. It may be easier to choose a property based on your current needs, but they may be soon irrelevant. Life changes quickly. So think long term when you buy. His rule of thumb is 5 years ahead. Where will I be in 5 years? What will I be doing? Then don't panic about prices. Unless you are selling, market movements aren't important. We all know how quickly prices change, so don't fixate on the value of a house. Focus on what will increase your enjoyment of this property, if it's your home, or what will increase the value of it if it's an investment. So I sound like there's 4 points there, but we'll stick with 3. Finally, this week, how to be more financially savvy. Personally, I advise my clients, and I do it myself, I overpay my mortgage, and it can save tens of thousands in interest. Most lenders will allow customers to repay up to 10% of their mortgage balance each year without incurring an early repayment charge. Earlier this year, NatWest increased its overpayments to 20%. So you can either commit to overpaying on a monthly basis or drop in a lump sum if you have cash to spare. I try and put £5,000 a year into each of my mortgages extra. It cuts many years off them. While some mortgage lenders are cutting rates, fixed term deals are still expensive, and paying down your home loan could have a big effect. For example, a borrower with a £350,000 mortgage on an average 2-year fixed rate of 6.58% and a 25-year term, according to Moneyfacts, overpaying by £200 a month would save nearly £71,800 in interest and result in the loan being cleared 4 years and 3 months early. So think about it. In comparison, if you put the same £200 a month into a savings account that pays the current average easy rate access of 3.1% over that 21-year period, the amount of time it takes to pay the mortgage off, because it's been cut by 4 years, you'd earn £20,000, 141 in it. So that's a £50,000 differential. This suggests overpaying your mortgage could be a good choice, as saving £71,000 in mortgage interest may indeed be preferable to the interest you would have earned. It's a great way to do it. Have discipline and pay it off. You can cut easily 5 years off your mortgage by just dropping £5,000 a year in, if it's like £100,000, £120,000 mortgage. So think about that. That's it for this week. Short and sweet. Thanks for watching. Please do share if you enjoyed. If you didn't, that's fine. Comment, and I'll try and reply to any interesting comments. Thank you very much. At least like it. Cheerio. Bye-bye.